the sort of silver squeeze, the sort of Reddit silver
The
craze
step sibling.
in 2021 generated a whole new generation that hates silver. Jilted lovers, if you will. And there is nothing that I like as much as a market that's hated. The silver equity market reminds me of the uranium equity market in 2022, which was stupidly cheap and had to be bought. So while I think I'm early on the silver trade, I can't help myself because I love hate. When I see the level of hate around the speculative juniors, I know I have no competition in the space.
In today's segment, Rick Rule, a renowned investor, shares insightful perspectives on the gold and silver markets, highlighting the current unique market conditions with reasonable valuations and a growing pool of investors poised for opportunities. With optimism for the next 18 months, Rule advises caution to retail investors, stressing the need to focus on individual companies rather than blindly following the sector, as only a small percentage of companies are genuinely viable. He underscores the importance of scrutinizing management, likening these investments to venture capital, where success hinges on the expertise of the team behind the company. Moving on, Rule anticipates a positive outlook for gold, fueled by market fears and concerns about the US government's impact on the dollar. He notes the potential of silver, drawing parallels to the undervalued uranium market in 2022, emphasizing the attractiveness of markets that are widely disliked. In conclusion, Rule advises caution in the precious metals market, suggesting that the easy money has been made. With that, let's dive into the video to hear his full thesis.
My experience has been that you have to climb that wall of worry, and the wall of worry has been in place. This is unique because I think we're coming into a good market and there's a big crowd. I haven't seen this occur since 1990.
Interesting.
I mean, for a very, very, very long time. So the fact that you have both reasonable valuations and people really ready and willing to take advantage of it strikes me as being unusual and fairly good. Now, I need to say, my own preference is for markets that are hated.
Right.
As a check writer, I like low valuations. The fact that when I look around the hall, I actually have some competition writing checks from my own personal view is not good. But from the point of view of the market, of course, it's wonderful. The retail investor has been trained for a long time to buy narrative, not arithmetic, which is why the retail investor fails as a class. I don't know if you realize this, but in the last 7 years, I've graded for free 80,000 retail portfolios. So I've learned an awful lot about the way retail investors think. And unfortunately, while there's a subset of retail investors who do well, most retail investors follow the big picture.
Yeah.
While money is made company by company by company. I think we're coming into a period for the next 18 months where the sector itself does well. It's important to note that if you look at this whole sector, probably only 10 or 15% of the companies are viable. And if you stick with the sector rather than good companies, you will lose, ultimately. You will lose.
Interesting.
So it's important that people know that. Management is where you look first, before you do anything else. People don't understand, I suspect, that these are venture capital investments. They're akin to technology investments. And it's all about the expertise of the team. It's all about the expertise of the team. Pareto's law, 80% of the work being done by 20% of the population. What you learn is that correlates at least for 3 standard deviations, which means 20% of the 20 do 80% of the 80, or 4% of the population generates 65% of the returns. 0.8% of the population generates 40% of the returns. If you as a junior investor hang around with serially successful people, you will make money. If you get outside of that, you will lose money. I think the most important new investor in the junior sector will be established mining companies. They're generating a lot of free cash. They have pretty good balance sheets. They have underinvested in exploration for 20 years. So they have no choice but to either joint venture or buy juniors. The institutional investors who are generalist got burned very badly in mining in the decade 2000 to 2010. They're not going to come back in until it's too late. That's just the way they are. They have a fondness for tops, which is wonderful. It gives us somebody to sell to. I think gold will do well. Gold moves generally on fear, and there's a lot to be afraid of. I think the broad economy is in good shape, but I think the US government is doing the best job they can to debase the dollar. And I think unusually for a government, they're being successful. I think there's a lot to be concerned with about the efficacy of US dollar-based savings. And I think that gold will benefit from that. People say that gold is breaking out to new all-time highs. That's silly. in inflation adjusted terms,
Right.
gold hasn't broken out at all. Gold has broken out against almost every currency in the world except the US dollar.
Mm-hmm.
But I think that gold will do in US dollar terms. In my experience, answering the rest of the question, silver moves after gold. Silver moves after gold has established momentum. What I like about silver is that it's roundly hated. The sort of silver squeeze, the sort of Reddit silver
The
craze
step sibling.
in 2021 generated a whole new generation that hates silver. Jilted lovers, if you will.
Right.
And there is nothing that I like as much as a market that's hated. The silver equity market reminds me of the uranium equity market in 2022, which was stupidly cheap and had to be bought. So while I think I'm early on the silver trade, I can't help myself because I love hate. When I see the level of hate around the speculative juniors, I know I have no competition in the space. There's at least 5 years left in this market, but the easy money's been made.
Yeah.
We could have a 20-minute conversation on the changing structure of the uranium market and how that means that the way people invest needs to change, but we don't have time for that. The take home is this: if you were invested in the uranium juniors, they're uniformly up 300%, 400%. When they moved from being hated to being tolerated to being loved, the easy money has been made.
Mm-hmm.
So I personally, big speculator in the space. 3 years ago, I've taken my money off the table. I have a lot of uranium stocks left, but what I have left is just my profit.
Interesting.
The money I had invested in the sector, I've got that back. It's safe. It's in my genes. The structure of the uranium market is changing, which means that there's big money ahead of us, but the easy money has been made.
In the following segment, Rick Rule dives into the dynamics of the uranium market, highlighting 3 critical developments. Firstly, he notes that the cost of uranium production, once $60 per pound, is now significantly below market prices, prompting a necessary price correction. Secondly, Sprott, Rule's former employer, purchased 50 million pounds of uranium, contributing to a supply shortage. Lastly, the Japanese decision to restart their nuclear fleet further reduced global uranium supply. Rule emphasizes the shift from a spot market to a term market in uranium, a change investors may not have fully grasped, with bullish implications. Additionally, Rule mentions a potential economic slowdown, acknowledging its capacity to postpone or moderate the commodity market boom.
3 things have happened. First of all, it got too cheap.
Mm-hmm.
It cost about $60 a pound, fully loaded, including cost of capital to produce a pound of uranium. 3 years ago, we were selling it for 20. So you make the stuff for 60, you sell it for 20, you lose 40. Being a miner, you try and make it up on volume. Didn't work. Price of uranium had to go up or the lights would go out. It was that simple.
Mm.
People's time preference is so short that they didn't care about the arithmetic equation. They cared about whether a 20-cent stock was going to go to 22 cents. They didn't give a damn about reality. They cared all about perception. Those people are my normal victims. There's a huge supply shortfall.
What about lithium?
Different topic.
Yeah.
We'll get to lithium in a minute. What happened in terms of uranium is 2 things in supply. One, my former employer, Sprott, bought 50 million pounds of uranium. That supply went to supply heaven.
Mm.
The second thing that happened is that the Japanese, the other major source of supply, decided to turn on their nuclear fleet again. So that supply came out of the equation. We went from being massively oversupplied to having the spot market short uranium. There's a pinch. The structure of the market is changing. It's going from a spot market to a term market. Investors haven't caught up with that. That has profound implications. The implications are bullish, but we don't have enough time to talk you through that. We can do that some other time. My suspicion, I'm not an economist, I'm a credit analyst. My suspicion is that we have a real risk of an economic slowdown.
Mm-hmm.
And an economic slowdown will not derail a commodity market, but it'll postpone it or make it less severe. Remember that you can have shortages of supply if you reduce demand and it doesn't move prices. Looking longer term, it is unescapable that there are 8 billion of us on the planet, that we're doing a wonderful job as a species, taking the 3 billion people on Earth who are the poorest of the poor and increasing their material standard of living.
Right.
We will absolutely, positively, without a doubt, without fail, have supply shortages in commodities. Will it occur in 2024, 2025, 2026? Probably not. Will it occur in 2028, 2029? Almost certainly. As an investor, you need to prepare yourself for that.
In today's insightful discussion with Rick Rule, we explored key market insights, emphasizing the convergence of reasonable valuations and a surge of investors. Rick highlighted the pitfalls for retail investors, urging a focus on individual company fundamentals, especially in the junior sector where management expertise is crucial. Moving to precious metals, Rick expressed optimism for gold and discussed the unique opportunity in silver, drawing parallels to the previously undervalued uranium market. In the uranium sector, he outlined recent developments, from cost dynamics to supply shortages triggered by strategic acquisitions and geopolitical decisions. As we wrap up, take a moment to recap on these key points and share your thoughts in the comments below. Don't forget to subscribe, like, and hit the notification bell for more finance insights. Thank you for joining us, and until next time, happy investing.